Did you know that understanding equity is crucial for anyone interested in accounting? In this video, I'll provide you with not just one, but two definitions of equity. We'll dissect its components and reconstruct them to gain a comprehensive understanding of what equity truly means and how it fits into the expanded accounting equation. Unlock the secret to financial success with Count and Coins, where numbers come alive and your accounting game thrives. At the beginning of this video, I promised you two definitions of equity in accounting. Here's the first one. Equity is the residual value of a company's assets after deducting all its liabilities. Sounds simple, right? Let me explain how it works. Let's bring up the accounting equation again. You'll see it quite often in this video, and it will become clear why later on. The equation states that assets equals liabilities plus equity. If we rearrange the formula, we find that equity is the difference between assets and liabilities. Accountants often use another term to describe this difference: net assets. So equity represents the net assets of a business, which is basically what remains after deducting liabilities from assets. Now let's move on to the second definition of equity. This definition states that equity represents the net funds invested into a business by its owners. I find this description helpful because it provides some context. To understand it better, let's go back to the accounting equation. On a broad scale, there are two ways a business can finance its operations. First, it can borrow money from third-party lenders like banks, which we classify as liabilities. Second, it can use the net funds invested by its owners, which we call equity. So equity represents the net assets of a business and, at the same time, the net funds invested by its owners. In other words, the owners have a claim on all the net assets of the business, and we call this claim equity. Now that we have an idea what equity means, let's take a closer look at its components. I must admit equity is made up of various elements, and some can be quite complex. However, I've handpicked three important parts that I believe will give you a solid understanding of equity and provide the most value. But before I share them with you, let's work with an example to make it easier to visualize all of this. Imagine you have a passion for sustainable fashion and want to start your own eco-friendly clothing brand. Inspired by the growing demand for ethical and environmentally conscious clothing, you're determined to make a positive impact. However, before diving into the world of fashion entrepreneurship, you need to make a crucial decision: how to structure your business. Should you opt for a sole proprietorship, form a partnership, or establish a corporation? Each structure comes with its own advantages and considerations. But for now, let's shift our focus to understanding equity and how it plays a pivotal role in your business's financial framework. I mentioned that equity is essentially made up of three things. The words we use to describe these three things change depending on the structure of the entity, which partly contributes to the complexity of equity. Let me explain. The first component of equity is capital contributions. Capital refers to the funds raised to support a business, and contributions mean that these funds are given to the business. Now, how we describe these contributions depends on who the owners are, which, as I mentioned, varies based on the structure of the business. If you're a sole proprietor, you're the only owner. So the money you invest out of your own pocket is called owner's equity. In a partnership, the owners are the partners, so the capital contributions are referred to as partner contributions. In the case of corporation, the owners are the shareholders, and the funds invested are called shareholders' equity. Essentially, we have three terms describing the same thing: capital contributions. Capital contributions play a vital role in financing businesses, particularly during the early stages before they start generating profits. Let's consider your eco-friendly clothing brand as a sole proprietorship. Suppose you invest $1,000 of your own money to kickstart your business. What does this mean for your financial position? Let's revisit the accounting equation. Your brand now possesses $1,000 in assets represented by cash, and as the owner, you hold a claim of $1,000 on those assets, known as owner's equity. This equilibrium maintains the balance sheet's integrity, reflecting the snapshot of your brand's assets, liabilities, and equity at that specific point in time. But capital contributions aren't the only component of equity. When your business generates revenue or incurs expenses, it will make a profit or a loss. which is simply the difference between revenues and expenses. So what happens to that profit and who does it belong to? It belongs to you as the owner. You can choose to reinvest these profits back into the business or hold onto them for future use. Over time, these accumulated profits and losses make up what we call retained earnings. Retained earnings are defined as accumulated profit held for future use. Fortunately, this term remains the same regardless of whether you're a sole proprietor, a partnership, or a corporation. So your business's equity is made up of two things: capital contributions and retained earnings. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. As your eco-friendly clothing brand starts to generate significant profits, you no longer need to rely on your own capital contributions to fund it. Instead, you can cover all expenses using the accumulated profits you've held onto and set aside as retained earnings. Within a year, your business is thriving with more cash coming in than going out. In other words, you have a net cash inflow. However, things aren't so rosy on a personal level. Since you've invested a significant portion of your savings into the business through capital contributions, you're running out of personal funds to cover your own expenses. You need to withdraw some cash from the business for yourself. How does that affect the equation? Retained earnings comprise two elements. As mentioned earlier, they consist of accumulated profits, which are your revenues minus your expenses, as shown on your income statement. An income statement tracks your revenues and expenses over a period of time. Additionally, retained earnings also include withdrawals. The money taken out of the business and distributed to its owners is categorized as withdrawals. However, the terms used to describe withdrawals differ depending on the business structure. For sole proprietors, they are called drawings. In partnerships, they're referred to as partner drawings. And in corporations, they're known as dividends, which are profits distributed to the shareholders. Again, we have three terms for essentially the same thing: withdrawals. As the sole proprietor of your eco-friendly clothing brand, you can use drawings to withdraw your accumulated profits for personal use. This impacts the accounting equation by decreasing assets because the business's cash decreases, and it decreases equity because your claim on the net assets decreases. Now, here's something interesting I'd like to show you. We've broken down equity into capital contributions, retained earnings, and withdrawals. Let's see how they all fit together using the accounting equation. Earlier, I mentioned that when we examine the accounting equation at a particular moment in time, we're looking at the balance sheet. The balance sheet consists of three components: assets, liabilities, and equity. We know that equity is made up of capital contributions from the owners and retained earnings, which are accumulated profits held for future use. Retained earnings can be further broken down into accumulated profits minus withdrawals. Accumulated profits are a business's revenues minus expenses, which are tracked in the income statement. So what we have here is the expanded accounting equation, which demonstrates how two major financial statements, the income statement and the balance sheet, are linked together through equity. In conclusion, understanding equity is essential in the realm of accounting. We explored two definitions of equity and dissected its components, including capital contributions, retained earnings, and withdrawals. We also examined how equity intertwines with the accounting equation and connects the balance sheet and income statement. Whether you're starting an eco-friendly clothing brand or any other business, comprehending equity empowers you to grasp the financial health and ownership dynamics within your venture. So, as you navigate the world of accounting, remember that equity is a fundamental pillar that shapes the financial landscape of businesses. Now that we've explored the intricacies of equity, I'd love to hear from you. Have you encountered any challenges or questions regarding equity in your own business or accounting studies? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications. So I'll see you in the next episode of Counting Coins. Happy accounting!